Hello, and welcome to Virtual Investor Conferences. My name is John Viglotti, and on behalf of OTC Markets, as well as our co-hosts, Alpha Transform Holdings and Blockchain Wire, we're very pleased you joined us for a panel discussion titled Digital Assets, the Future is Now. Please note you can submit questions for the presenters in the box to the left of the slide, and you can also view any of our presenters today availability for one-on-one meetings through the Schedule Meetings tab found on the conference platform. At this point, I'm very pleased to welcome our moderator. He's Enzo Villani, Chairman and Chief Executive Officer of Alpha Transform Holdings, as well as our panelist, Dan Siciliano. He's the chairman of the Council of Federal Home Loan Banks and co-founder and chief executive officer of Nickel, as well as Michael Turpin. He's the general partner of Alpha Transform Holdings and the chief executive officer of Transform Ventures. Welcome, Enzo, Dan, and Michael.
Glad to be here.
Thanks again. Thanks for the nice nice intro. So thanks everyone for actually joining this conference. We appreciate your time. I'd like to first actually start off with Michael Turpin and Dan going through their backgrounds to kind of give you some context, and then we'll start going into the actual conversation about the future of is now on digital assets. So Michael, do you want to start first?
So I have been in the blockchain world since early 2013. Prior to that, I was a serial entrepreneur in more general technology. I started the first internet-based news release service called Internet Wire, which then partnered with NASDAQ back when Enzo was the head of strategy there, and it became known as MarketWire, which was then sold for $35 million and is now owned by Apollo and is called Globe Newswire, and it's about $500 million property, one of the leading company newswires in the world. I also, in the .com era, I helped with the launches of Motley Fool and a number of other sort of iconic early internet brands. So when digital assets came around, I sort of felt that I'd seen this movie before and was excited to be in at the very dawn of that industry. I have worked as an advisor or marketer for, I guess it's about 400 projects now, including Ethereum, Tether, Bancor, Neo. At one point, I worked with 60% of the CoinMarketCap top 100, other than Bitcoin. As I like to say, Satoshi didn't have a budget at the time. And I'm excited with all the directions that are happening now in the sort of latest iteration of digital assets. And I have a book coming out in July called Bitcoin Supercycle, published by Skyhorse, distributed by Simon & Schuster. Look at it at the airport or a news shelf near you.
Great, Michael. Thanks, Dan.
Great. Yeah. I think the short version is I'm a serial entrepreneur who accidentally became an academic, who then, figured out that I want to be an entrepreneur again and did that. What I do now is I mainly serve on bank boards, and I run a fintech. The boards on which I serve are the Federal Home Loan Bank of San Francisco. I'm currently chair of that. And then I'm the immediate past chair of the system of the Council of Federal Home Loan Banks. Happy to expand on that. But if you don't know us, and lots of people don't, we're very, very big, but we operate quietly behind the scenes as liquidity providers and affordable home providers for the system. System balance sheet above $1 trillion is quite interesting. I'm a Stanford trained economist who ended up wandering over to law school, figured out that they were having a lot more fun because they didn't do quite as much math, and spent my career there, co-founded the Rock Center for Corporate Governance with Joe Grunfest. And during that time, confirming what you knew about law school faculty all along, I managed to build a company that turned out to be a SaaS compliance company for the Fortune 1000 and sold that to Thoma Bravo. The work I do now is with, aside from the board work and the financial liquidity work, with Nickel, we actually provide liquidity opportunities in a novel way. It's a spinoff from a Stanford project, as it turns out. That's why I left, for late stage unicorn employees. And as it happens, I think the happy end of that story in a few years will be very blockchain centric. At the moment, it's not. It's very private equity centric. But someday I think you'll see liquidity provided and matched in a very smart, efficient way on blockchain between what we consider the private markets of pre-IPO companies and other investors and employees. But I'm sure we'll talk more about that in a moment.
Great, guys. Thanks a lot. And just real quickly, I wasn't the head of strategy at NASDAQ. I led the issuer services side, and I actually helped to actually create the kind of corporate services group. This webcasting software is actually the webcasting software that was at NASDAQ. So it's kind of interesting. It's like a full circle type of thing happening actually today for me. But yeah, so let's just start off with the basic question, right? Which is, like myself, I came into actually digital assets because I basically recognized that that the code stack of blockchain was the most efficient clearing and settlement system in the world, and it's free code. So all of this code that was built by the banks and the actual brokerage houses and the exchanges and the clearing and settlement firms and all that stuff, the efficiency of this technology just went beyond it. And the fact that it's open source makes it very hardened, right? It's hardened technology. So and so how do you think about what made you first say to yourself that blockchain was going to change the way things were happening? And where do you first think that, what do you think are the next 2 to 3 things that are going to happen in the next, 3 to 5 years, let's say? Michael, do you want to start?
Sure. Well, I saw the power of blockchain and crypto very early when I went to the first Bitcoin Foundation conference in May of 2013. I saw a lot of the same people that came to the early internet conferences and made a lot of money there. And in many cases, they retired and came out of retirement to pursue the blockchain industry. And so I was like, if I'm in a room with a lot of the smartest people I've ever known and they're looking at something, it's probably something there. And, just like in the early days of the internet, I saw companies like, Yahoo go from little 10 by 10 booth to multi-billion-dollar public listings. The very first Bitcoin Foundation conference in San Jose had little 10 by 10 booths for companies like Coinbase with Brian Armstrong handing out T-shirts. I still have that T-shirt. And so I saw that it had the potential to really be digital gold, to disrupt, the to create a new asset class and disrupt the financial markets by being an alternative to, the endless drum of money printing and the sort of unpopular in the world economy backing of gold. And I've just sort of followed it ever since. And it's always been an issue of when institutions would come on board. And that sort of started in 2017 with CME. And then obviously with all the ETFs this last time, that is really what has kicked off, what I believe is going to be a new super cycle post the halving of last week.
Great. Dan?
I'm always embarrassed to say that I became very aware of Bitcoin early 2013, and like Michael in one respect, got to interact early with Brian Armstrong, and Dan Bonet is at Stanford. If you're a law professor, you learn quickly. You are not in the top half of the smart people on faculty at Stanford, so you need to wander around campus and meet the smarter people. Dan Bonet is among them, and so I got to hang out with all those people, and we actually did a cool event early at Stanford in I think it was the late spring of 2013, and it was about Bitcoin, and it was really filled to the rafters. It was unusual, to have that happen in our largest auditorium there at the law school. I am sorry to say I didn't quite follow my own advice at the time, which was, hey, just put a little and let see what happens. I followed it a little bit, not enough. And so it's an insight in the following way. If you looked at who showed up, and this is, exactly what Michael was saying, at that time, there was a real pattern there. There were people who were sophisticated serial entrepreneurs who had spotted early trends before, were willing to forego a life of wealth and leisure and go back into the fray, often in their 40s, 50s, and 60s, and go at it again, which was a really interesting signal to me. And I think one of the things that, if you look at it, I take away as a signal of what's coming in the future is the fact that there are many tens of thousands of highly skilled individuals endeavoring to make what we think of as the blockchain Web 3.0 community and functionality better. And for everything that was ever a brief bubble or an innovation that didn't go anywhere, you cannot find that depth and breadth of talent working at it for such a long time. That doesn't guarantee that it becomes world transforming, although I think it will be, but it is a signal that this is neither a fad, nor a bubble, nor a temporary phenomenon. It is fundamental because there's so much talent at play. And the one example I'll throw out, and we can maybe move on, I'll tease it, is that I spend a lot of time in the banking system, and I'm an admirer, by and large, of the amazing banking system that the United States has. And yet, on an absolute scale, it isn't really doing what it's supposed to do. Banks are a mess. It's hard to run a bank. It doesn't satisfy a lot of the consumer needs, and that's no one's fault in particular. I think banking at its premise is a hard thing. In the United States, we have more choices and options than most people have. But 15 of our banks now control about 78% of the deposits, and that trend is only increasing. And a lot of people are left out of the banking system. That trend of consolidation means that people are moving from somewhat higher yield to lower yield as they move into the top 5 QSIBs. There are all these trends that are, if you're a Reddit, user, mildly infuriating. It's not something that ruins your complete week, but by little strokes, you're like, oh, really? That again? And so I think the groundwork is laid for a change that brings lots of solutions to millions of people who will not think of this as Web 3.0, blockchain, forget all that. In the same way people don't pay attention to underlying IP protocols, they will not pay attention to the rails. They just want solutions. And there's so many solutions coming to the fore now, at least in my world, in the banking world, that are available only running on Web 3.0 rails. And that I think that's almost inevitable.
Well, it's much more efficient, it's much more frictionless, and it's cheaper, right, to run it, because it's basically open source code that's been hardened by hundreds or thousands of different devs. They're all working together. They're sharing the actual code stack. But let's kind of focus on this. Let's focus on the concept of finance, money, printing, value of money, the value of transfer, the unbanked. What do we think is why is this happening? One, and like KYC, is KYC really, it almost seems like it's hurting people that don't really have any issues. And it's turning everything into this very kind of draconian monitor state. How do you think about all this stuff? Why is this happening, and what are they really what's the goal here? Because I think one of the biggest pushbacks, the reason why Bitcoin was invented, if you read the Bitcoin white paper, and everyone should, because it's more than just a white paper about technology. It's really about the reason why it was actually created was because of the 2008 credit crisis. And to be quite honest, everyone's like, blockchain's fraud, this, that, the other thing. But at the end of the day, blockchain is more transparent than anything out there. You would never have a daisy chain problem with CDOs if it was on blockchain. You don't have naked short selling if every stock was on blockchain, because everything would be tracked and it would be efficiently tracked. So why do you think this is, why do we see this trend of the consolidation of banking even into these 5 or 6 or 10 most powerful banks in the world, which we all know always ends poorly. It always ends in a bad place when you have too much power by two kind of little people. And then you have Bitcoin and you have the other side of it. Why do you think it's happening?
Do you want me to go first
I'll
before
start.
Michael? I can give
Yeah.
I'll give you an overview. I think Michael and I, interestingly, arrive at very similar conclusions about the applicability of what is now present in blockchain and crypto, but from very different directions. So from my direction, I think the reason that the banking industry is heading the direction is that that's the best it can do. It has several complex limitations. Transactions costs are everywhere. Settlement is unclear. I mean, it's just a hard thing to do. And I know we're not inclined to be forgiving of banks, and I'm not trying to be apologetic to banks, but consolidation is occurring in part because to absorb the challenge of banking, you need to be really big. And then there's the government interface. So here's my analogy, and then I'll give a little bit of answer, but I want to hand it over to Michael, then maybe I'll add. And that is, maps were something that have existed forever. But when map technology, became more advanced and we had comprehensive and accurate maps, that changed the world. That was really amazing. But they were always paper, right, or something else. And it's only been in the last 10 or 15 years that we have transformed to a world in which we don't generally use paper maps. And yet paper maps stuck around for a long time. And there are things that digital maps on your phone, et cetera, can do that paper maps just can't do. And we were able to adopt that. I don't know anyone, I'm sure there's someone who carries a current edition of a paper map in their car. I'm sure there are some people who do so. But by and large, we all now rely on a phone. And that's the difference between the banking system. So the maps on paper got better and better and better, but in the end, they could not be updated remotely. They could not tell you where to go. If you asked page 13 and page 19, how do I get from there to there? Please tell me. That was nonsensical. The book of maps simply couldn't do that. Banking is an impressive structure. It is one of the amazing modern inventions of the world, but it's a paper map. It has fundamental limitations. The Web 3.0 world and the permissionless environment that engenders allows for this equivalent migration into a digital map world where you can enable all these things because the transactions costs are so much lower, the verification is so instantaneous, et cetera. So I can build on that, but that's the difference. I don't think we should say banks are just stubborn. Well, yeah, maybe, but banks are stuck with the legacy model they have, and it just has limitations. It's like criticizing the paper map for not talking to you. It can't. It just can't. And you have to migrate to something else. But a lot of people have paper maps. And like my dad finally gave up the paper map, right? But that was only a year or two ago. He was like, you have to carry a paper map in your car. And it just took a long time. So I'll leave that, and then I can come back to some very specific examples about the why. But don't have the paper map to talk to you. That's crazy.
Yeah.
I'd like
blame banks. Again, Michael.
I was just saying, I'd like to answer the first part of your question about KYC. KYC, which didn't exist until after the Patriot Act, has been a horrific failure. It's been one of the main reasons why crypto has not been that adopted. I mean, in the early days of crypto, I would tell, very intelligent serial entrepreneurs and investors in traditional technology investment, you should look into buying some Bitcoin. They go, oh yeah, that sounds great. Let me go and call my broker. Well, no, your broker doesn't have it. Oh, well, how do I get it? Well, there's a few exchanges that are fairly easy to onboard where you can self-custody, but most people weren't, ready to do that. So I say, well, go to Coinbase or go to, Kraken. And then they come back and they say, oh, it was a nightmare. They wanted like all this information. I don't know who these guys are. They're not my bank. Why should I give them all this information? And then it wasn't enough. And then I found out that they couldn't deal with putting it in a trust. And so forget about it. These are people who wanted to buy significant amounts of Bitcoin when it was like $200, $1,000, $3,000, $7,000, and every single time they were stopped by KYC. KYC, my good friend Bruce Fenton, who's the head of the Satoshi Roundtable, former executive director of the Bitcoin Foundation, he comes out of the TradFi space. He's had a very big, he was Morgan Stanley for a number of years. He's had a very big, practice for managing like the money of billionaires. He basically noted, and I forget the exact numbers, but it's something like it costs about 10 times as much in compliance costs than the entire amount you're trying to safeguard. So in other words, I forget the exact number, but let's say it's $600 billion a year to run the KYC industry, and they catch $60 billion of possible violations. In most cases, they're just possible violations. Meanwhile, the biggest ones, criminals don't follow KYC. So it really is is not
Right.
solving what it's supposed to set out to. And what it is it ends up sort of building this behemoth industry that just feeds upon itself. And the banks love it because, they get to pass the cost along to their customers, and it keeps the opposition of people taking money out of the bank and putting it into their own bank, known as a digital asset wallet, away for a while, because it's just too hard to comply with this, unnecessary layer of regulations. In addition to which, it creates a huge honeypot of data for hackers.
What's funny is that it's both, you guys are both right in this sense, where the reason why the banks have to be so big is because of the cost of being a bank, which is tied to KYC being so onerous by the government Patriot Act. And it also doesn't really, it's really not even that effective, because basically, if you're a criminal, like, you can't, like, you might catch something, I guess, but if you're a criminal, you're not going to follow KYC rules anyway. You're going to figure out another way to do it, right? So you'll have a false, a fake passport or fake documentation. So I don't really get it.
I know a colleague is going to be meeting with Senator Warren later today, so I was thinking about this a little bit extra. I actually understand and believe in the motivation for why KYC is put in place and AML, and understand that backdrop. But the part that I think requires a leap of faith, and where we're stuck, and it's very unfortunate, is that in a completely Web 3.0 financial system, you have a lot of other less costly options to achieve many, if not all, of the same goals. Now, that's a policy debate, right? If you want to achieve those goals and how you go about doing that. But the optionality of being able to achieve them is much greater in a fully, Web 3.0 Rails world, right? You can have certain types of transactions are required to use a certain type of token that has built-in features that allow for, like, you can come up with anything you want. Now, I'm not saying that's the right or wrong way, but I am pointing out that in a way, KYC is asking the paper map to write down some lists and keep them for itself. Like, the paper map doesn't do that either, right? Not easily. And that's why it's so expensive to do. And my observation would be that we need to kind of have a phase shift, and it's always uncomfortable because you have to let go of what you have and hop into the next thing. And in the current KYC environment, again, the origins, the motivations, and what I do, I almost am obligated to say this, but I actually believe this. I think it makes sense what we're trying to do, but it's a little bit like my gated community, where if you just put Amazon delivery person, it opens the gate. Like, it's an automated gate. Like, so the only people who get stuck are my mother, right? Who's like, well, I'm not going to lie. I'm like, mother, just press that you're an Amazon delivery person. She's like, that's lying. I'm like, well, the things say it, so you have a system where it's the folks who are engaged and willing to comply who are caught, and those who are the most sophisticated avoid it. And no one wants that. Like, that's not what we meant to do. And I think in a really pure blockchain driven, finance postmodern world, we decide what we want. We could calibrate it how we want. It'd be a lot less costly, and we get exactly what we want. Because, by the way, as we all know, but many policymakers don't, if you want, there is complete point-to-point transparency on blockchain. If you want,
Michael, I know Michael.
There's a number of. I was gonna say there's a number of solutions out there already. It's the matter of which ones would be accepted by various governments, but there's already at least 50 self-sovereign ID programs out there, which effectively do the same thing. You go in and you do all this stuff once only, not every single time you apply for something. You scan your passport, you get biometrics or whatever, and and then you go in and you have it encrypted, and you then have a key that's generated from that encryption saying, I have complied with the regulations that if you're a government group, you can open it up with a key, but it's not accessible to any random person who hacks the cloud and gets all your information, including your social number.
Well, you know what? There's even one more step there. Which is what I'm seeing with companies that do this kind of homomorphic type of encryption, and this idea of, you don't need to know all of my information. You just need to know that my KYC is ready, is valid. So when I do KYC, it's validated by this hard wallet, basically, that basically says, yes, this is, he's checked out, he's accredited or not accredited, or whatever the the reason for the actual KYC, but you don't need to know, all of my information. Like it's not necessary. So and in a world where you want a fast type of, where the kind of transaction friction drops, there is no T+3. It's minutes, or if not seconds. Your KYC is basically this encrypted little wallet that basically identifies you as who you are, and you can get rid of a lot of these pain points. I mean, there are some of the companies that I tried to do we do it for as a fund. I just gave up. I was just like, you know what? I don't need to do this. I mean, I have plenty of other exchanges that I'm working with and so on. They just wanted so much, and I'm like, what do you? It was just way out of control. So just to switch subjects just a little bit, I want to talk about the money printing. Everyone's concerned about the dollar, the debasing of the dollar. Are we going to lose our reserve status? All of this stuff. And I think this is a good group, between you and Dan, Michael, that, you guys have probably similar views of what's going on, but very different viewpoints. So I'd like to talk a little bit about that, if that's possible. And this concept of the unbanked is also another topic. So, like, people who aren't banked, how are they holding their cash, and are they keeping things in cash? Like, what do they do, right? So, and holding cash is actually not a good thing, right? It's not really a powerful. It's not really, if the value of if inflation is going up, the value of that dollar every time you hold it every day, it's just going down, down, down. So that purchasing power is being lost. I'd like to talk a little bit about that.
Sure. So that's true. I mean, 100 years. Oh,
Sorry.
I can go first, or you can go first, Daniel.
Go ahead,
Why don't you
Mike.
go first? It's a trad funding discussion.
No.
Okay, I'll do short.
Michael,
Let me do short.
go
I
first.
want to hear what you say. Yeah.
Yeah,
So
I want to hear you
and so
first.
Michael says you go first.
Okay.
You go first, Michael.
So I was going to say 100 years ago, before you had the kind of inflation that you have today, the people who were unbanked simply kept their cash in a mattress, right? Or they had it in gold buried underground in the backyard. And that was acceptable back in the days that the dollar was backed by gold. They were one and the same. That's been 50 years now, 53 years since we went off the gold standard. And that's been where all of a sudden you've had this, hyperinflation that's accelerating to almost Weimar Republic levels. And the whole question is, can the United States get away with what no other country in its position has, because they're the greatest economic power in the world? I mean, Japan certainly is hyperinflated, and it wrecked their economy for decades. And the entire world economy, which focuses around what the U.S. economy is doing, it gives the rest of the world the excuse to print even more than we do, meaning that you'll now have 100% plus inflation in some very large third world and second world countries like Nigeria, like Argentina, and it just ruins the wealth of the middle class. And so, I've been fond of saying that we're going to have the equivalent of the Arab Spring, but for financial instead of for human liberties. And it's not going to be in the Middle East, because they seem to have their act together better in those areas. That's where I just came back from a week and a half in Dubai for Token 2049, 400 crypto events. It's become now the world capital of the blockchain, because New York and London didn't want it. They had too many regulations, and they're opening up with with open arms. Dubai, Abu Dhabi, the very, very good banking laws, good regulatory, and the world is coming there now, and it's going to become the New York of the Web 3.0 if the U.S. and the EU don't want to drive these businesses to Dubai, which is where they're going. I mean, I can't tell you the number of people there who are former Americans and former companies that should be in San Francisco and New York City or in London or in Paris, and they're now based in Dubai because it's the only place they can do what they want to do. But basically, for what I was going to say with the, I'll call it the African Spring, you're going to have in LATAM and in Africa, country after country after country, where the central banks go bust. This will happen way before it does in the United States. When it gets to 20, 30, 40 countries that basically have their central banks go bust, and this has happened already in a dozen countries. Ecuador doesn't have a central bank. Panama barely has one. They just use the U.S. dollar. And using the U.S. dollar is a horrific thing because you're then relying on an economy that's printing dollars for their own people, particularly their own wealthy, and you're then having to go and borrow money in dollars and pay it back by converting your own dollars, your own riad, your own rupee, your own peso at rates that are you're borrowing $1 million, you got to pay back $5 million 2 years later plus interest. And so the IMF has been this real source of poverty that Milei, the new ruler and the new president in Argentina, has remarked that it's really killing off. I encourage everybody to watch this little 15-minute talk in the World Economic Forum where he basically just said that socialism is ruining the world economy and it equals war and death, and that entrepreneurialism is the way to go. And he ended up his stirring speech by saying, "Long live freedom, damn it," and then walked away with a mic drop. And I think that he will be next, along with Paraguay, to do what El Salvador did, to basically add to the U.S. dollar Bitcoin. And the IMF predicted ruin. And they're still now saying you have to drop Bitcoin or we won't give you any further loans. Meanwhile, El Salvador has become an economic miracle. Since they did that, they're now positive on their Bitcoin programs. They've created a lot of wealth in the country that wasn't there. Crime is down 90-something% because a lot of it was driven by drug gangs and cartels. And I see this happening in Nigeria. Nigeria right now. The Naira is hyperinflating at, well over 100% a year. Nigeria just sued Binance for illegally selling Bitcoin to its citizens for $28 billion. Meanwhile, there's a drop in the bucket as to what is happening peer-to-peer transactions. In Western Africa, there are $600 million a month of peer-to-peer transactions. And so this is happening very rapidly. And as we're going through an upcycle in Bitcoin right now, you're going to find that the Africans who are turning their Naira into Bitcoin and then into stablecoin are wealthy, and the ones that don't are not.
Wow.
All right. So I'm going to I'm going to try to I'm going to let Michael. Yeah, I'm going to let Michael own the ground on the kind of macro and international theory side. Although I will say, I think people don't realize that on an actuarial probabilistic basis that banking and finance done well or done wrong is life and death, right? Like on the margins, it impacts people in a way that shortens their lives or does not allow them to live a good life. And done well, it enables like liberty and freedom. So it is real stakes, even though it feels very removed, right? So let me comment just on the underbanked and unbanked in the United States. It's a problem that's hard to measure because there are all sorts of proxy or alternatives. You can function in the economy even if you do not have a bank or are under or unbanked. However, you're at a very persistent disadvantage, right? So it's very hard for you to accumulate any wealth, even in small increments. You're not getting any yield on anything. When we had zero interest rates, maybe that didn't matter, but now it matters a lot. And you don't have the ability to establish any sort of record or credit so that you can be afforded credit at the right times in the right ways. And so it is a weird irony that we have like Venmo running on, TradFi structures where and so you have kids, we have kids about the same age, I think, they don't think twice about having all of their Venmo transactions be public. Like, I'm like, wait, why don't you have the privacy? What do I care? It's cool that everyone knows I just split with my friends $120 of dinner. I'm like, right. So the irony is that we have that going on, and yet we have a whole segment of people who aren't creating a record of any sort of credit-worthy established patterns. And so I think as soon as the Web 3.0 world provides a Chime-like interface to DeFi rails so that the average user just doesn't even perceive the complexity, then you're going to have enabling, the ability of people who are under or unbanked to access what they think of as banking services much more directly. And again, I always have in mind people who I think generally are well-intentioned but aren't achieving their goal. Let's imagine a staffer in Senator Warren's office. They're like, well, what we need to do is we need to protect people against the predatory nature and not let them take too many risks. And, there's no one to intervene on their behalf when they make a mistake in a permissionless world. Well, that's all fine and well, unless they aren't even a part of either of those worlds. Like if they are literally handed, they're handed debit cards, one-time use debit cards, because no one will give you a paper check anymore, and they take those and they spend them down, right? And the one borrowing they do is the modified, modern version of payday loans, right, which have usurious rates in the 300 to 500% ultimately, right? And no kind of rails around it. It's a mess. And so my observation would be this innovation. And I agree with Michael about the potential risk and terrible loss of opportunity in the United States. This innovation, if only we would create some safe harbors, if we would create some sandboxes. I mean, look at Singapore, look at other places where we can allow people to have proof positive projects and show and learn some things. Say, oh gosh, that didn't work out well for this category. Let's change it in the future. If we did that, then you would have innovations which solved problems. It's a little bit like saying we can't let doctors prescribe in 1965, antibiotics to people unless they've been demonstrated to have been cured by antibiotics before, and you can't research new ones because, there's been some bad things that have happened. But that's just craziness, right? Like why would you do that? So you have to have a path from here to the innovation and then use it more carefully. And that's, that it's silly not to allow that to happen. And it's not really happening. The average consumer in the United States who is underbanked, they engage in the DeFi world, technically in violation oftentimes of regs and laws, or not at all. And that's a shame.
So actually, DeFi, I think, is definitely the next level. I mean, so the way I look at everything is as a market center. And, or a market, like the market is, the original market is like the piazza or like the little center market. Like there's still these global markets where you can go buy spices and food and all that until in the real world. That's where humans kind of interact. And then you have the stock market, you have like the open outcry, and then you have like the limit order book. And now you have, and as you get through this, I think what Uniswap first invented was brilliant. I mean, it actually is the next level of the market system, the automated market making and all that stuff. What do we see in the future in the next couple of years? Where do we think the markets, where do we think the market structure is going to go for payments, for stocks, for equities, for tokens, for whatever? And then we have two questions here that I'll want to go over. And kind of ask them, because I think that they're good questions, especially for CFOs of companies. And how do you kind of participate in this trend? I think that we should tell people about how to, yes, there's a lot of problems that we're solving, and those problems are terrible, and this stuff can really fix it, and that's a great thing. But let's give people a little bit of examples and case studies of where they can go to start going down this road to kind of take advantage of this new technology platform. But yeah, I would love to hear more about like what's your thoughts about DeFi and what's your thoughts about the market systems in general.
Let me do a narrow
in the next
answer.
3 years.
Yeah. Let me do a narrow answer just in one way, which is real world assets on chain. So Enzo, you and I talk about this all the time. If you were to invent the current exchanges, if you were to invent the stock markets as we know them, you would absolutely not design them the way we have them. I was shocked in the same year I learned about Bitcoin and blockchain was the year that it was clarified to me what this concept of in a proxy battle, what overvoting was. And it was kind of casually thrown out. It was like, oh, overvoting. Yeah, it's when we add up all the votes, we have more votes than our shares outstanding. I'm like, what do you mean? I was like, well, it's a little complicated because there's held in account, held on street name. And sometimes it all gets added up. Some votes were voted, some shares were voted twice. I'm like, and that's okay. They're like, yeah, there's no way to solve it really. Like this blew my mind, And so I think at the very least, when we talk about the end game of DeFi, you have these, what sounds to, I think, traditional finance people, exotic things like what's an AMM? What do you mean you have a liquidity pool and there's no, there's no book for sales and there's nobody in the middle? Oh my God, you don't even have to go there, in my opinion, to get a lot of people excited. You simply have to say, you know what? There's this thing. It creates an immutable record. It is reconciled immediately. It is impervious, to distortion. It is visible to everybody, and it's relatively costless because it's open source, and you can all move in and out of it. And then, by the way, there's a bunch of innovators on a layer above it doing all sorts of cool stuff. And maybe for this thing that you keep all these records for, and they're always behind, maybe we should run that on that, and it'll cost you less. Your auditors will be like, wow, I can just look at this. That's cool. I can just look at this and it's all there. And you will have instant and total immediate reconciliation every moment of every day. Stop there. Don't talk about markets. Don't talk about AMMs. Don't talk about liquidity pools. That should win people over because they save money, they improve visibility, they reduce audit costs, and all sorts of good things happen. So that's my prediction for the next 1 to 3 years. Things like, certain types of bonds on chain, what nickel does, and I can talk more about that later. So what we should do, and we will get there, we're going to invent it if we must, is we should be facilitating an environment in which people who have private company shares in a way that's compliant with what the company allows are in a marketplace that tokenizes those, and you should be able to slice and dice and bundle them and create a portfolio. Like the private pre-IPO companies, the 20 largest US pre-IPO companies right now are bigger than what the stock market was 40 years ago in market cap. And we can't trade in them. Like they have this clunky secondary market. It's crazy. And that market is costly, opaque, hard to regulate, unfair to little players. It should all be on chain, every last bit of it. Right. And the company says, but how will I control it? Fine, make your token proprietary. It has its own rules. It's self-executing. Unlike, by the way, I worry, for example, like players like Databricks. There's a rule. If you have more than 2,000 actual stockholders who aren't employees, then you have these reporting rules. And they remember when Google went public in a hurry, it's because they had hit the 500. We changed it with the Jobs Act. It's a little more permissive now. But big companies are suddenly like, ooh, people have been selling shares. We might have more than 2,000 shareholders. It's a mess. Imagine a world in which that simply isn't possible. You have permissionless constraints around a constructed token. You always know where it is. Your cap table is automatic. Anyway, that's a no-brainer. It's just visualizing the path from here to there. And I can talk later about the issue. And then you have to make it not just legal, but okay from a regulatory viewpoint for banks to touch these things. Here's the problem in the United States. Whether or not it is legal is no longer the practical issue. The issue is a regulator for almost any financial and financial services institution. When they show up and you say blockchain, token, heaven forbid you accidentally say crypto, like the guns come out, or at least the clipboards with like heavy big ends on them, and they beat you to death. And that's a problem. We have to distinguish between thoughtful and not thoughtful use of modern technologies. And that perception has to solve to really allow for some of this other stuff to work.
So when both the buyers and the sellers agree that a technology is better, it inevitably gets there. The question is how long? Yeah. I remember when there were people running around the floor of the New York Stock Exchange with pieces of paper, right? And I remember a friend of mine who had 3 seats on the stock exchange said, yeah, they'll always have that. And then a few years later, he said, in 5 years, they'll all be gone. Of course they're gone now, right? And it was controversial when NASDAQ came out and started replacing those people doing like piece of paper and on the floor, because that was done for centuries and other 15th and 16th century markets that way with technology. But yet it's taken us decades to even get rid of the DTCC, which technically owns everybody's stocks, because of course you couldn't catch up with the settlement time from computers in real time. Well, now it's not a problem. We got high-speed trading. So all the things that, Dan, that you just mentioned, they should have been done years ago. There's no reason that the private company market shouldn't be tokenized and the public company market. I actually, years ago, when I was speaking at the Polymath conference, was one of the earliest security tokens, is now called, tokens to regulate securities and to basically enable them. It's now called Polymesh. And they had a lot of heads of various exchanges. And I went up to some of them and I said, when do you think the Toronto Stock Exchange, the Canadian Stock Exchange, et cetera, are going to go and allow this? They said, we have none of our members asking for this. They like T+3. They like having the cash around. And so it's really a matter of, what they call regulatory capture. It's the institutions that put the rules in place. There's now a whole industry like KYC built around enforcing those rules and adding new rules. And the biggest donor to political campaigns is the traditional financial agencies. I mean, the market to these agencies and to the president on down. And so it will really take a new generation of leadership and lobbying. Just like I remember in the days when Google first came out, I was told that they'd never be able to get any kind of voice in Washington because the telcos, the cable companies have bought up all the lobbying firms, and they can't get anybody to represent them. Well, top person of the firm leaves, starts their own firm. They're the one with the relationships. And now I don't think you could say that Google has no power in Washington, right? And so I think it's the same thing as the price of Bitcoin keeps going higher to 100,000, 200,000, 500,000. I mean, at 100,000, it's been estimated that the majority of the world's billionaires will be crypto billionaires. And so at some point, that money moves into politics, moves into changing laws, moves into, look, if we had RFK Jr. as the next president, all these things would be dealt with very quickly. But, Biden in particular, fresh news from the last couple of days, they're now looking at enacting 45% capital gains tax and a 25% tax on unrealized gains on crypto as well as stocks. I mean, that would just destroy the middle class and the upper middle class. It would destroy the stock markets. They already have the salary time they have it. And of course, you don't have an offset for unrealized losses. You basically get to write off $3,000 a year or whatever in millions. So these things are all problems that will only be solved when the right people come into power or put through lobbying efforts, the right people in power.
So, Michael, I agree with a lot of the key points you're highlighting, although I have a slightly more optimistic twist, which is I think you're underestimating the power of the American public to be envious and jealous of others' access to true capital markets. And so let me tell you a little story about what's evolving now. So Nickel, assembles portfolios of positions in these very late stage pre-IPO companies by cooperating with their employees. General counsels like us because it's compliant. The SEC likes us because it's compliant. It was hard to do. Stanford spinoff. It was a cool thing. Okay. And we create these pools. Well, the way we fund it, we have to do traditional funds. It's a private equity fund. Why? Because there's no other method to do it. That's a terribly inefficient way to fund this capital need, by the way. So what are we doing? Well, we wanted to build a market, based on, digital rails in the United States. It's a no-go. It's just too fraught, right? Like there's FINRA, it's just too fraught. So what's going to happen? We're going to do it out of Singapore, Dubai, and probably Europe at this point, right? And so the irony is that there's a huge appetite at the retail, sophisticated, accredited, and even unaccredited investors to get access to these companies, because you can't invest in Google before it is 100x anymore. It's already a $10 or $20 billion company before it goes public. So those days for average people are gone. So what's going to happen? We're going to build a blockchain solution that ultimately is probably an AMM, but even before that, that allows retail investors only from Europe, only from Dubai, only from Singapore, no US, to invest in these US companies. And I assure you, within a year or two or three, the outcry from retail investors, in the United States that says, why can't I get a piece of Databricks like this guy over there? And it's a US company and I live here in California and I wasn't able to. And the answer will be because the acceptability and the clarity around these regulations for purposes of blockchain solutions are too vague in the United States. I don't think any politician will be able to survive that once it's really clear that we are cut out of those opportunities. So I'm hopeful that will happen sooner rather than later, and the pressure will come to bear. And yeah, I just hope that, I think the American public is very rational when push comes to shove, and I think that politicians are politicians. They need to respond to that. So I'm hoping that we'll get this experiment, this grand experiment, and Europeans will be like, nah, 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 and United States investors will be, I'm not going to tolerate that. That's my hope.
Great. I'm just going to read one because I think we covered some of the first question and the second question. I think the third question here is thoughts on the future of new non-finance Web 3.0 application opportunities beyond the current focus on fintech applications. So, yeah, that I think is. I mean, we invest
That's kind of
as
your
a
world, then.
fund.
So I was
We
going to say there's
invest. Yeah, we invest in AI. We invest in. So like we actually built this social index product that is AI focused tokens. So and we had invested in some of the top three of in that sector in 2020, and now those three are actually merging. But that index actually returned 700% in a year, beating everything under the sun: Bitcoin, Ethereum, S&P, the Nasdaq, everything. So I do think that AI is a really important part of this, right? AI and blockchain. If you look at the application of AI meets blockchain, okay, you could literally have an agent that represents you, KYC'd or not KYC'd or whatever the KYC is. You could have it, kind of manage your actual health records, your finance records, your all of this stuff, and the AI agent was really trading or doing your transactions. It could be paying bills, it could be doing everything for you. So I think that in a world of frictionless transactions, T+0 or T+1 second, AI will be doing a lot of this for us. And I think it's going to be really, really amazing as that starts to evolve. What type of Web3 applications do you guys think will be something that's going to be outside of the fintech area that could change, just change the world?
I have one example, and it's kind of an oddball, but I think it will be bigger. It's just very early. I think in the same way that the early efforts spoiled it for a while, DAOs got kind of this, mixed reception. People didn't understand them. The outliers that did badly are in the news. The ones that work aren't. In the same way that if you're old enough, there used to be BBSs, bulletin board systems, right? That's pre-website. Then there were websites. Then there were platforms, and now we have our social. Okay, so there was a progression, and most of those BBSs were hilariously bad. Okay, so why do I care about the DAO? Because there's a lot of organizations throughout the world that deserve a much better automated, transparent governance system that needs to be customized. And we in the United States, we sort of did that halfway. We created the limited liability company. It's state by state. Delaware has it, but that you can slice and dice it, but it's still cumbersome, right? So imagine a world in which you can spin up an HOA governance structure, right? I'm not necessarily a fan of HOAs, but there's a bunch of them, and they all deserve better governance. You could create DAOs that have better governance for HOAs. You could have solved the open AI nonprofit, for-profit, cap profit thing by creating what is a postmodern benefit corporation in a DAO structure that ties directly to Delaware on-chain allocation of ownership. Like, you can do all the things you can imagine without having to hire lawyers and accountants at every single intersection, which is what makes it impossible now. Only billionaires get to craft custom corporate forms, because to spend $1 million one time and then $100,000 every quarter isn't a big deal. But HOAs can't do that. You and I can't do that for a trust. We can't do that for anything for our kids. This governance flexibility, which is automated, we're not paying attention to it now, but I predict that someday you will see city councils, you'll see school boards, you'll see HOAs, you will see corporate forms, you'll see nonprofits. They will have this automated blockchain-driven structure, which is permissionless but changeable for all these functions, and we will save so much time. Never go to an HOA meeting again. Someday.
Which would be, I think a lot of people would not want to go to HOA meetings.
Right, but why would you? You know what? Why even bother? Why? It should all be automatic. Just run, right? And you can get 95% of the way there with the modern DAO structure.
No, so I believe in DAOs. I think DAO is actually corporate governance. Michael?
Yeah, I was going to say media and social media. Obviously, media, Alpha Transform Holdings, we have a portfolio company that we incubated called Blockchain Wire, and we're looking at different ways of using Web3 to basically make permissionless media, which we think is a big opportunity. And then on social media, which I think will probably come first, I remember when Facebook and Twitter and the other early social media platforms came out, everybody laughed at them, and now they're among the biggest companies in the world. Right. And they're all centralized, they're all controlled. You can you do something wrong and they'll remove your LinkedIn profile and all the things that you built, you can never get back, and they won't even tell you why. And so you now have the ability, or at least nascently, with a couple of the companies. I'm an advisor, an investor in a company called Social.network. I can't believe they actually got that URL. And their original vision was that you would go in and be able to buy whatever address you want. I'm actually Michael at Social.network. And then you could go in and permission, build what you want, and you are the one who then gets the benefits of it. If you end up going in and building a huge audience and you have people subscribe to it, you're the one who ends up getting the benefit of that. And I think there'll probably be 5 or 6. There's one called Friends Tech that lets you token gate your communities. And, people want to go and spend time on social media building their community, but they don't want to go and have all the value go to these big tech companies that have made billions off of the efforts of others when they can keep it inside the community themselves. And so I think that Social.network is really an interesting play, and it's very early. They're now involving Bitcoin staking as part of the way that you can end up earning some of the credits to buy things there. But I'm very bullish on that field.
Well, that's and that's what I love about the whole kind of tokenized concept, is that the concept is that the economy itself is run by a decentralized infrastructure, and everyone gets a piece of the pie all the time, right? Every transaction, everything that happens on the actual network, the folks who are validating, the folks who are participating are all part of it. So we're going to have to wrap up now. Thank you for your time. Michael and Dan, any last, 5-second words for our group here?
I'll do a 12-second, which is, I think within a year or two, we will be able to realize Nickell's vision, because all these things will come together. That we'll have a tradable environment that will work very well, and it'll be tokenized. So I think that's inevitable, and that's small potatoes, all things equal, but I think it's indicative of all the innovation that'll come down the pike. Michael?
I would just say to the audience, if you're not already in the crypto economy, this is probably your last chance for the average person to own even one Bitcoin. There's only 21 million that will ever exist. 20 million of them are already out there. 5 or 6 million of them are perhaps lost or haven't moved in years. And another 10 million are sort of held by long-term holders. And if every millionaire in the United States wanted to buy one Bitcoin, they couldn't. So we're going into the halving. I've got my book coming out in July, Bitcoin Supercycle. And I would just encourage everybody to don't talk about Bitcoin until you actually own some.
Yeah. Great. Thanks, everybody. Thanks for
Thank you.
your time.
Thanks, Enzo.